You're listening to AI PRISM from Seoul Economic Daily.
It's Thursday, May 21. I'd like to share some thoughts about Finance Daily. Right now in Korea, there is this really intense, well, almost a structural tug-of-war going on in the financial system. We're looking at some fresh reporting from Seoul Economic Daily, and I want to map this out for you.
Yeah, it is a really fascinating dynamic to watch. I mean, on one side, you have banks just pouring billions into single tech giants. And then on the other, there's this massive debt crisis brewing for the self-employed.
Right, and banks seem, completely unwilling to step in there. So let's start at the top. To understand this, we need to look at what the Financial Supervisory Service, the FSS, calls principal debtor groups.
Right, which is really just a technical term for Korea's absolute largest corporate borrowers based on their total debt. And, well, the scale of bank exposure to these groups right now is staggering.
Yeah, I was looking at the numbers. If you combine KD Cookman Bank, Shinhan Financial, and Hana Financial, their exposure has reached 114.6593 trillion won. That is roughly 81.9 billion US dollars.
It's a massive number. And the single name concentration within that is even wilder. I mean, just Samsung Electronics alone accounts for 7.3607 trillion won of that total. That's about $5.26 billion tied to one company.
Wow, that is heavy concentration.
Yeah, and Shinhan actually had to officially warn about this concentration risk recently in a U.S. SEC filing, basically saying, if Samsung's balance sheet takes a hit, it's a huge vulnerability for the bank.
It's kind of like putting all your chips on the AI semiconductor cycle, right? Like, if the cycle holds, great, but what if it doesn't?
Exactly. But you have to remember, this extreme concentration isn't just banks being reckless. It's actually driven by government policy.
Oh, you mean the productive lending policy?
Yes, exactly. The Financial Services Commission, or FSC, has this mandate.
Yeah.
They basically want banks to shift away from household debt and funnel capital directly into strategic corporate investments instead.
Right, acting almost like an arm of industrial policy. And we can actually see this playing out with Hana Financial's latest numbers. They just committed 17.8 trillion won, which is about $12.7 billion, strictly for 2026.
Yeah, and that's actually a bump of 1.6 trillion won, or $1.14 billion from their original plan.
Exactly. And they are aggressively targeting AI, semiconductors, and healthcare, with this broader goal of hitting 84 trillion won, or $60 billion, by 2030.
So the capital is definitely flowing where the policy wants it to go.
Yeah.
But there's a serious catch here. When you direct that massive fire hose of capital toward the top-tier tech giants, you inadvertently starve the smaller borrowers.
Which brings us to the inclusion gap. While all these billions are flying around at the top, self-employed debt has crossed 1,000 trillion won. That's $714 billion. What happens to the underbanked here?
Well, the government did try to build a bridge. They designated 24 what they call premium money lenders. These are legal licensed lenders specifically meant to serve people who can't get traditional bank loans.
And the idea was that commercial banks would lend to these premium money lenders at lower rates so they could pass those savings down to the low credit borrowers, right?
That's the theory, yeah.
Yeah.
But in practice, it is completely failing. Right now, bank borrowing only makes up about 8 to 9% of these moneylenders' total liabilities.
Wait, really? Only 8 or 9%? If the government is explicitly encouraging this pipeline, why aren't the banks actually lending the money?
It comes down to reputational risk. Banks are just terrified of the optics. I mean, they do not want their pristine corporate brands associated with high-interest money lending, even if it is legally sanctioned by the state.
Oh, so they just avoid it entirely to protect their image.
Exactly. And on top of that, there's a regulatory hurdle. The FSS currently classifies these specific loans as corporate loans, not inclusive finance. So the banks don't even get any regulatory credit for taking on that PR risk.
Wow, so the incentives are just completely broken. It leaves you with this really provocative question for the listener. As policy aggressively pushes all this capital toward AI and tech giants, how will the financial system bridge that growing access gap for the bottom 20%? Especially if banks absolutely refuse to shoulder the reputational risk to help them.
Yeah, it's a structural divide that is only getting wider.
That's today's AI PRISM Finance Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.